Good afternoon, and thank you for dialing into our first official KBRA quarterly public finance market update call. I'm Dana Bunting, and I'm head of the Public Finance Investor Relations team. In my role, I'm responsible for covering investors from institutions to SMAs to retail sales forces, as well as the top 20 underwriting syndicate desks. We're all very excited about this call and the upcoming series where we will highlight specific areas of rating focus for KBRA and how we often take a different approach from our competitors. Today's call will focus on the airport sector. Thanks for joining. Before I delve into public finance, I'd like to share a few stats we're extremely proud of here at KBRA. In the 7 years since KBRA began, we've issued 8,818 ratings, totaling $740 billion in par. We have 54 methodologies and have written 460 research pieces, something which we are well known for. Among many certifications, we are recognized as an NRSRO by the SEC and a designated rating provider by the NAIC, both important designations for the public finance sector. We're ranked #1 in several sectors in the market, most notably in the ABS or asset-backed securities space. We are very focused on expanding our footprint in the public finance sector through continued brand recognition and market acceptance from all players in the muni bond market. To date, we've assigned nearly 100 public finance ratings and growing. In my 5 months at KBRA, we have met 30 investors that we hadn't visited before, and most of the top 20 syndicate desks. Results are overwhelmingly favorable. Our credit reports win the day. They are extremely thorough, timely, and most of all, they're transparent. A good combination of quantitative and qualitative analysis which helps investors supplement their own internal credit work. One investor actually told us they use our reports as a training tool for new analysts. We took that as quite a compliment. Syndicate desks indicate that bonds with a KBRA rating trade well, and they too acknowledged our in-depth credit analysis written by well-seasoned analysts. Every investor we've spoken to has indicated that they would buy a bond with a KBRA rating and only 1 rating from either S&P or Moody's, and that 3 ratings are not necessary. Our reports add value. We hear that time and time again. Finally, market receptivity around the recent pricings of Texas Trans and the Pennsylvania Turnpike was overwhelmingly favorable, and some investors noted our reports to the desk. We heard from the desk on Pennsylvania Turnpike that spreads were tighter than prior pricings, and the number of investors on the book were far more than expected, especially in the first 15 years of the deal. Although not a definite, we'd like to think our AA- rating, replacing a competitor, contributed to those favorable results. The list of issuers who want to have a KBRA rating, KBRA tell their credit story continues to grow. Now I'd like to introduce Karen Daly, Senior Managing Director and Head of our Public Finance and Financial Guarantors Rating Group. She'll speak briefly, then turn it over to our airport specialist. Afterward, we'll open the call to questions. Again, thanks for joining us. We recognize you all have busy days and we'll be succinct in our remarks.
Thanks, Dana. Good afternoon, everyone. My name is Karen Daly, and I manage the Public Finance and Financial Guarantee teams at Kroll Bond Rating Agency. KBRA has generally viewed airports as strong credits that are well managed and play a very significant role in their respective local economies. We believe that airports as a class of credits are underrated and note that this sector has experienced no defaults on publicly rated debt. Airport management, which KBRA believes is underemphasized by others, has performed a critical role in confronting the challenges this sector has faced over a prolonged period. I will be joined on this call by Harvey Zackham, Managing Director, Bill Cox, Managing Director, and Andy Clark, Senior Director. Harvey will step us through the U.S. General Airport Revenue Bond Rating methodology that covers 6 major rating determinants: management, economics, airport utilization, debt and capital, finances, and legals. Bill will summarize our research on the proposed lifting of the cap on PFCs. I'm now going to turn it over to Harvey.
Thank you, Karen, and good afternoon. The KBRA General Airport Revenue Bond Rating Methodology, which was published in April 2014, is a product of in-depth discussions with bond issuers, intermediaries, and our own research on this asset class. In the process, we came to embrace two main underlying principles. First, airports are underrated. Ratings have tended to be clustered in the A category, despite the fact that there has never been a default of a publicly owned airport. We published research on this topic in the summer of 2015 in a study titled A Case for Airports, which is available for free, as is all of our research, at our website, kbra.com. Furthermore, airline use agreements, cost recovery mechanisms ensure that required coverage is met. A second critical finding was that airport management is underemphasized as a rating factor. There's hardly a reference to management in competitor reports. KBRA believes that strong management is vital to the airport's successful operation. Management has performed a critical role in confronting challenges the sector has faced over a prolonged period, starting with deregulation in 1978 to the more recent financial crises, airline bankruptcies and consolidations, endemics like H1N1 and SARS, and terrorist acts. We have written in detail on this topic in Why Effective Airport Management is Essential, which is also available at no charge on our website. Our airport rating methodology applies to all U.S. airports regardless of size and complexity. It considers 6 rating determinants. For the referenced reasons, management stands out and is our first rating determinant. The other determinants are economics, airport utilization, airport debt, airport finances, and legal mechanics and security provisions. Under each determinant, there are several subdeterminants. There's a total of 41 subdeterminants in the methodology. These qualitative and quantitative factors give us detailed insight into all facets of airport operations and afford transparency to rating assignments. Our methodology does not assign weights to particular factors and is not a scorecard intended to predict a rating outcome. We are not wed to any one metric. For example, cost per enplanement is widely reported, and we report on it. However, we do not give undue weight to it since it is a small component of airline costs, and its impact is often mitigated by high yields and load factors at a particular airport. KBRA looks at each airport rating assignment as being unique, and to upend an old adage, once you have seen one airport, you have seen one airport. Therefore, on a case-by-case basis, we will determine the relative importance of the subdeterminants. At this juncture, we have 9 general airport revenue bond or GARB ratings, which in the order they were initially rated are Dallas-Fort Worth, John Glenn Columbus, Miami International, Tampa International, Chicago O'Hare, Chicago Midway, Manchester Boston, Salt Lake City, and Harrisburg. We have also rated the subordinate lien bonds of Tampa and as well as the consolidated rental car facility bonds. At this point, I wanted to touch briefly on our views on this asset class. We do see challenges for the sector, particularly the need to address capital requirements, which arise from forecasted increases in passenger and cargo traffic, aging of existing infrastructure, and the need to maintain a state of good repair. Besides helping ensure the U.S. aviation system remains globally competitive, these investments improve the quality of passengers' traveling experience, as passengers have increased their expectations of airports. The substantial need for investment in U.S. airports is underscored by the fact that many airports were built in the 1950s through 1970s period and are now outdated and were never intended to accommodate current passenger volumes. The Airport Council International of North America, ACI-NA, Airport Capital Needs 2017-2021 report published in March 2017 accentuates the scope of this issue. The report estimated capital development needs at nearly $100 billion for this period, or approximately $20 billion annually. This represents a considerable bump up in the identified capital needs, as ACI's 2015 report identified $75.7 billion for the 2015-2019 period. These needs range from terminal buildings to airfield capacity, reconstruction projects to surface access, and address passenger growth, cargo activity, and rehabilitation of existing infrastructure. Since passenger service and cargo demand are expected to continue, we would expect additional infrastructure needs to be identified. According to ACI-NA, airport-generated net income, airport improvement program grants, passenger facility charges, or PFCs, capital contributions, and state grants generate about $10 billion annually, which results in a funding gap of about $10 billion. However, many airports are already highly leveraged, having issued substantial amounts of debt, and alternatives to airport-issued debt provide limited support. In particular, the PFC has remained at the $4.50 per flight segment cap since legislation raised it from the $3 level in 2000, and its value has eroded due to inflation. In addition, a large portion of current and future PFCs have already been committed to the debt service of past and current projects, which constrains usage for future projects. There have been various airport-supported efforts to increase the PFC, including one now being considered by Congress. KBRA published a special report in September that looked at the impact of an increased PFC for the nation's 30 largest airports. Bill Cox, who authored the report, will now discuss the findings.
Thank you, Harvey. Good afternoon, everyone. I will provide an overview of KBRA's research report on PFCs in 4 steps. First, I will discuss some high-level metrics regarding the existing PFC program. Next, I will describe the proposed change that came out of the U.S. Senate Appropriations Committee this past summer. Third, I will explain how KBRA attempted to quantify the potential impact of the Senate proposal on large hub airports. And fourth, I will highlight a few data from our conclusions. If you are on this call, you most likely have a good understanding of the PFC program, so here are just a few data points that you can see in slide 1. Since their inception in 1992, PFCs have contributed over $50 billion to airport infrastructure needs. In 2016, according to the FAA, PFC collections, net of airline administrative fees, hit a new record at over $3.1 billion. The FAA projects further growth, with net collections likely to exceed $3.3 billion in 2019, all else being equal. As most of you know, the PFC fee is currently capped by Congress at $4.50 per segment on up to 4 segments on a round trip. This effectively means that PFC charges are capped at $18 on a round trip with connections or $9 for a round trip with no connections. In the context of all of the other fees and taxes that passengers are experiencing, KBRA believes the PFC seems quite small, especially given the impact these dollars can have on offsetting the infrastructure needs of America's airports. Therefore, KBRA finds the Senate proposal interesting. As stated in our airport ratings methodology, we generally believe that PFC dollars can have a positive impact on credit ratings because they can reduce the need for debt and/or subsidized debt service payments on existing bonds. So what is in the Senate proposal? In July, the U.S. Senate Appropriations Committee approved a fiscal year 2018 Department of Transportation spending measure that includes authorization for airports to raise the PFC by $4 for originating passengers only. We believe this would mean that the maximum total PFC charged on a round-trip ticket could grow to $26 instead of $18, or $17 for a round trip with no connections. KBRA's understanding of the bill is that there is one catch for large hub airports. The catch is that large hubs would have to give up the remainder of their AIP entitlement program grants if they choose to implement the additional $4 PFC on originating passengers. With all that in mind, KBRA tried to quantify what this Senate bill might mean. We did this in 3 steps. As you can see in slide 2, our first step, we estimated the number of originating passengers for each of the large hub airports, and then discounted that amount by 10% to account for certain passengers who are exempted from PFC charges. Multiplying that by $4 gave us a baseline estimate of the potential amount of PFC dollars for each large hub airport. We also built a model inside our airport database that showed how that amount could grow given various assumptions about industry and airport-specific employment growth. In step 2, as you can see in slide 3, we estimated the amount of money each large hub airport would have to give up from its share of the AIP entitlement grants if it adopts the $4 increase. This helped us derive the net amount of new money that large hub airports could generate. Then in step 3 on slide 4, we compared this amount to each large hub airport's most recent published 5-year capital improvement plan. Based on these assumptions, KBRA reached the following conclusions, which are, of course, just meant to be estimates. The Senate proposal could yield, net of lost AIP entitlement grant funding, over $6 billion to large hub airports over the next 5 years. This amount could cover roughly 14% of these large hub airports' published capital plans. For some airports, such as SeaTac, McCarran, BWI, JFK, Newark, Phoenix Sky Harbor, Miami, and others, the new PFC dollars could potentially cover more than 25% of their published 5-year capital plan. It's important to note that in the base case, KBRA modeled an assumption of 0% employment growth. Therefore, the PFC dollars and the percent coverage of capital plans could be even higher under more likely growth scenarios. Meanwhile, for all U.S. airports, KBRA estimates the Senate proposal could yield over $10 billion over the next 5 years. This compares to ACI's estimate that Harvey just mentioned of over $100 billion of capital needs during that same time period. KBRA believes that in an environment where new infrastructure investment dollars are difficult to find, this would be very welcome news, especially given the fact that these PFC dollars come directly from the users of the airport facilities. With that, I will now turn it back over to Dana and Karen to field any questions.
Thank you, Karen, Harvey, and Bill. We would like to open the call now for questions, so please feel free and submit your questions.
We're going to give everybody a minute. Don't be shy. All right, we've got the first one coming in. You guys said that there's no publicly owned airport that's ever defaulted on debt payments, but what do you know about defaults on privately owned airports?
Okay. Well, while there has been no U.S. publicly owned AirGARB default, there have been cases of default by fixed-base operators at general aviation airports. As far as defaults at airports with scheduled service, the only one that we found in our research was the Branson, Missouri airport, which was privately financed and non-rated, and probably should not have been built given that it was considered a speculative project when financed in 2007.
Thanks. We've got one coming in on PFCs. What's the next steps in terms of what's going to happen in D.C. in terms of the PFC legislation?
It's a good question. We have been trying to keep track of developments as best we can, but as we all know, the federal budget process is a real grind, and lifting the PFC cap is not without opposition. We believe the final FAA budget, with or without amendment language addressing the new PFC cap, will probably be in place by year's end. And we understand that the Senate and House Appropriations Committees need still to reconcile their respective budget bills. So the fate of the PFC language likely rests on whether the Senate leaders who overwhelmingly supported their original bill will maintain their steadfast support during this grinding negotiation process, and that is something we should know in the coming months.
Okay, there's another one on PFCs. You mentioned that PFCs are an efficient source of capital. What do you mean by that? Can you explain what you mean?
Sure, it's all relative when it comes to public sector revenues, but we believe PFCs are relatively efficient because they are charged to the passengers who actually use the airports receiving the funds. This is different than most federal taxes on airline tickets. In the case of those taxes, The money goes to the federal government, which then allocates the money by formula or by grant competition back to airports. And there are good public policy reasons for doing this, but for large hub airports that need capital dollars to invest in airport infrastructure, the amount of dollars returning to the airport from federal ticket taxes does not come close to equaling the federal taxes collected from passengers who actually use those specific facilities. Another feature of the PFC that makes them efficient is, in the big picture of public finance, is that the PFC funds can only be used for approved projects, wherein the airlines and the FAA have say in whether the projects are deemed important or essential. This helps keep PFC dollars from being gobbled up in bureaucracy or some mistaken priorities.
Okay, another one on the PFCs, Bill. If the PFC is increased, would it apply to prior approved applications?
My understanding is that it would have to go. You'd have to go back to the FAA, since there's a ceiling with each approval as to how much can be collected, and so that might have to be adjusted.
Thank you. It's got a methodology question, and this comes up all the time with investors. KBRA doesn't assign weights to rating determinants. Why? And does that mean that all of your rating determinants are considered equally?
Well, the first part of the question I'll address. We feel that it locks us in some ways to a predictive rating, which the methodology does not envision. We look at everything being equal at the outset, but as we delve more deeply into a particular credit, there's likely to be factors that require more weight and consideration. As I said earlier, no two airports are exactly the same.
Any additional thoughts on airport ratings in the pipeline in your shop?
We're meeting with and having ongoing discussion with various airport representatives. At the present time, I'm not at liberty to be more specific than that.
I'm going to turn it back over to Dana.
Thanks, everyone, for listening in today and for providing your questions. And expect the next quarterly public finance market update call in 3 months. If anyone has any suggestions of what they'd like the topic to be, please feel free to email or call me. And again, thanks very much. Have a great rest of your day.
Thanks, everyone.